Hi, this is Adam Khoo here. It's on the 9th of October, and yesterday was a pretty red day, a big red day. Dow Jones was down 300 points as US China talks kind of like collapsed, right? Now, if you read the news in the mainstream media and you watch all these interviews or videos from stock experts, most of them are saying that we are now going through a stock market crash. The market's going to collapse. It's a recession. We're going to hell, right? Now, question, are they right? Is the market gonna crash? My honest answer is, I don't know and I don't care. Now, why don't I know and why don't I care? For a very simple reason. After being in the markets for the last 26 years and making so much money from the markets, I've learned one thing, that no one can predict the future of the stock market. No one knows exactly where the market's gonna go next day, next week, next month, or even next year. Why? Why can't anyone predict where the stock market's going? Very simple. What drives market prices? Demand and supply, right? When more people buy, market goes up. More people sell, market goes down. What drives demand and supply? Emotions, right? When people are fearful, they sell. When people are optimistic, they buy. So it is emotions that drives market prices in the short term. In the long run, market prices are driven by fundamentals, right? Earnings. But in the short term, it's all emotions. Now, here's the thing. I can't even predict my wife's emotions the next morning. If I can't even predict one woman's emotions in one day, how can you expect to predict the emotions of millions of investors around the world? It is impossible, right? So whoever attempts to predict the stock market and they say gold's gonna go up this year, the market's gonna crash, you know what? They're all guessing. No one knows. Now, here's the good news. Making money consistently from the stock market has nothing to do with predicting the stock market. Nothing to do with it at all. And I never predict the market. All I do is I follow the market. That's it. In other words, when a market's on an uptrend, I'm bullish. I stay long, I buy, I make a lot of money, right? But when the market's on a downtrend, I go bearish. So I short the market, right? I don't buy anymore. In fact, I buy put options to protect my portfolio as the market collapses, so I make money as it collapses. So never attempt to predict the market. Never attempt to outsmart the market. Always follow the market. And I'm going to show you a lot of examples in history how every time you attempt to outsmart or predict the market, you get screwed by the market. So here are a few examples right now. Now let's go back to the year 2009, right? Seems like a long time ago, about 10 years ago. And at that time, the Dow Jones was at about 9,700 points. 9,700 points. So people are wondering, where's it going? Is it continuing higher or is it going to go back down again, right? So they go read the mainstream news, okay? Now, this is on CNBC. On the 5th of October of 2009, what did they say, right? Portfolio managers predicted that the Dow Jones will fall to 6,003 by the end of the year. Ooh, bearish, right? Here's the funny thing. The next day, on the 6th of October, complete turnaround, right? Now on CNBC, experts are saying, hey, the Dow's going to go to 10,000. So who the heck do you listen to? The answer is no one. Don't listen to anyone. They're all clowns, right? No one can predict the future. I can't predict my wife's emotions, right? Instead, just follow the market. So let's look at where the market was at that time. Okay, so this was the Dow Jones, and this was exactly on the 6th of October right here. So again, one group was saying that it's going to drop to 6,000. The other group was saying it's going to go to 10,000. And now it's at about 9,008. So what do? Simply follow the trend. What does the trend say? Is the trend on an uptrend or downtrend? The answer is on an uptrend, right? You can see the 50 moving average above the 150 moving average. Moving averages are sloping up. The price is making higher highs and higher lows. What do? You stay long, you buy. And if you just follow the market, instead of attempting to outsmart the market, boom, that's what happened. Sure enough, the Dow Jones went up to 10,000, 11,000, and now it's at 26,000. Now, what if you had listened to these guys, right? You would have sold everything and you would have missed that great run in the markets. Or worse, if you had shorted the markets, you have gotten killed because of listening to people making dumb predictions. Okay? Now, let me tell you that even among the billionaires of this world in investing, no one can predict. Even the billionaires can't predict where the market's going, right? Let's go back to 2011. On the 22nd of September, George Soros, what do you say? He said the US is already in a double-dip recession. We went through one recession in 2008. We're now going through another one in 2011. So he was bearish and he shorted the market on the 22nd of September, 2011, right? 1 week later, on the 30th of September, Warren Buffett, another guy, billionaire, said, hey, I'm buying stocks. US recession is very, very unlikely. So who was right? Was Soros right? Was Buffett right? Well, let's take a look. Boom. Buffett was right? From the 30th of September, the S&P 500 went from 1,200 to 2,100. There was a 75% gain over 3.5 years. So if you had listened to George Soros's predictions, what would have happened? You have missed out on a 75% gain in 3.5 years. So again, I reiterate, never listen to people's predictions because no one knows where the market's going. No one's a fortune teller. All you got to do is follow the trend. Now you can see over here, the market was initially on a bit of a downtrend over here, right? So you wouldn't wanted to have bought over there. But over here, what do you see? That's right. The moment the moving averages begin to cross from the smallest moving average to the biggest moving average, the trend has shifted, right? You can see the 50 moving average, the blue line, crossing above the 150 moving average. Once they start sloping up, you go long, you buy, and you would catch that trend all the way up over here. Now, over here, you can see the 50 crossing below the 150. Would that have been a sell signal? No, because you can see the 150 is sloping up. A downtrend is only confirmed when moving averages slope downwards. When they slope up, even if there's a crossover, that's not a downtrend. So simply follow trend. It's as simple as that. Let's look at an even closer example. 2016, Donald Trump versus Hillary Clinton, right? So that was the 2016 elections. And you know what? Everyone was predicting that Hillary would win. Me too. I thought she would win. I never thought that Agent Orange would win. Anyway, he won, right? But what did everyone say? Everyone said that if Trump wins, expect a swift sell-off in US stocks. If Trump wins, the market's going to crash. That's what everyone said. All the news media said that. In fact, this guy, Mark Cuban, another billionaire, he said that stocks could crash 20% if Trump becomes president. Guess what happened? The moment Trump became president, that's what happened. There we are. So the moment the news was announced, the market went up 12.4%, and everyone who predicted otherwise got screwed by the markets. Now again, never predict, follow the trend. You can see that even though the market went down slightly before the elections, but the 50 moving average was still above the 150 moving average. In other words, the trend was still up. You just follow the trend. And even smart people sometimes make mistakes, like George Soros. So Soros, he attempted to predict the market, right? So what do you do? He bet $1 billion that the market's going to crash, and he lost. He lost $1 billion 1 week, well, not 1 week, a few weeks after the election, because he went against the trend. So again, never go against the trend. Okay, when I was young, one of my gurus told me, he said that there are 3 things in life you never go against. Number 1, never go against the power of love. Number 2, never go against gravity. Number 3, never go against the trend. Okay, so you got that? All right, so with that, let's look at the markets right now. With the Dow dropping 300 points, are we still on an uptrend? Are we still bullish, or have we turned bearish? All right, so we're looking at the chart of the S&P 500 on the daily candle. So again, yesterday we had a 300-point drop on the Dow, 45-point drop on the S&P 500, which is pretty significant for a particular day. So that was yesterday, right? You can see I'm circling that was the drop yesterday. Now again, a lot of people out there are predicting that we are going through a stock market crash. It's going to be a recession. We're going to go all the way down, okay? And there are a lot of reasons people are giving, right? So one reason is people are saying, well, you know, this is like a head and shoulders pattern, which is a very bearish pattern in in technical analysis, head and shoulders. Some people say, well, it's because the market from making higher highs is now making lower highs. All right. Some people say, okay, it's broken the trend line. There's a trend line over there. It broke the trend line, so it's going to go all the way down. So there are many technical reasons. And of course, there are fundamental reasons as well. People are saying because of the impeachment, right? Because of the trade war getting worse and worse. So again, people are giving all kinds of reasons for predicting that the market's going to crash all the way down. And what I mentioned earlier on is we never want to predict the market. We want to follow the trend. So the question is, are we still on an uptrend? Now, as a lot of you know, I use the short-term moving averages. I use the 20 and 40 EMA to determine the short-term trend. I use the 50 and 150 moving average to determine the medium-term trend, and the 200 moving average to determine the long-term trend. So there's a trend within a trend within a trend. Short-term, medium-term, long-term trend. Now, currently, we are in a short-term downtrend. All right, you can see the prices are below the 20 EMA. So we're in a short-term downtrend, short-term correction. We are down about 5% from the highs, which is a very normal correction in a bull market, right? And so far, you can see the 150 moving average, the green line, has been acting as a pretty good support. Yesterday, the market closed below the 150. So tonight is pretty crucial. Tonight, we've got to see if the market can bounce back above the 150. Okay, if it can't and it continues to stay below the 150, chances are it could go down and test the next support over here, which is about 2,820 points, 2,820 points. Okay. Now, for now, the 50 moving average remains above the 150. All right. So for now, the medium-term trend is still bullish, and our 200 moving average is still going up. So we are still bullish on the medium to long-term trend. But again, you never know. In a couple of months, if the 50 crosses below the 150 and the 200 slopes down, we could be going to a bear market. You never know. Again, you can't predict, but as it unfolds, I'll be watching it very carefully. But for now, I'm watching the 2820 level. If tonight the market can't get back above the 150, my next target for the S&P is 2820. Now, if we break this level, if we break the 2820 level and we break below the 200 moving average, where's my next target? My next target will be over here. All right, over here. This is the 2600 target. Okay. So if the market drops where it is right now all the way to 2600, that's another 10% drop. So that will make it a total of a 15% correction in the market. Now, does it mean that we are in a bear market? No, not really, right? Remember, in a bull market, it is normal to have corrections, even up to 5 to 15% corrections, okay? If I were to zoom out to the longer term perspective, you can see how I derive the levels. All right, let me just zoom out again. All right, there we go. Over there. Yeah, okay. So you can see that this level was a previous strong support level. All right, 2600. Okay, and that's how I got that level, 2600, which I mentioned earlier on, 2600. Okay. And this level, you can see, was again a very strong resistance and a strong support, which is 2820. There we go, right? So again, my first target, if we break the 150, is 2820. If we break the 200 moving average, will be 2600. Now, if you zoom out even more from a monthly perspective, let's take a look at that. Let me show you the monthly charts. Right. So over here, you can see on the monthly charts, okay, even if it goes down to 2600, which looked like a pretty big drop, right, from a daily perspective. But if you actually look at a longer term perspective, even if it drops to 2600, it's okay. The overall trend of the market is still going up from a monthly candle perspective. In fact, you can see that every time the market has a correction, it tends to find the support at that level, right? So at that level, I'm not surprised if it goes back down again and hits that level, and from there it could even make a new high. So you never know, right? So even if it goes to 2600, it doesn't mean that we're going to go to hell. It does not mean that we're in a bear market. It could still be a healthy correction as we go higher. Now, having said that, right, no one likes the market going down even for the short term. We know that the stock market will always go up eventually, but no one likes to see the prices of their stocks going down in the short term. So as both an investor and as a trader, what do? How do I make sure that even if the market goes down in the short term for the next couple of weeks or months, I'm still making money or I'm still making profits? And again, I use options, right? So I use put options in order to protect my portfolio to generate profits as the market collapses. And there are three ways you can use put options to protect your portfolio. The first is to just buy a straight put. The second way is to use a put spread. And the third way is to use what we call a calendar put spread. So I'm going to show you how I use it right now. Now, while you can trade the S&P directly, a lot of people like to use the ETF. So I'm going to use the SPY, which is the S&P 500 ETF, because it's it has a lower price, so it's more affordable for most people to trade this. Okay. Now, a lot of people, what they do is they simply buy a put on the S&P ETF, right? So if you buy a put option, for example, if you think the market is going to go down, you buy a put option, which is like an insurance policy. So with a put option, the more the price drops, the more money you make. So for example, let's go to trade now, and you can choose an expiry date which you want. So for example, if you want to protect your portfolio for say 2 months, right, 60 days, you would choose the options that expire in 60 days or so. So the closest I can find would be this one. This option expires on the 20th of December. So you're protecting your portfolio for 72 days. So these are the put options over there. That's the expiry date. And we could buy a put option at the money, right, at about 288.5. So the closest would be 288 over there. There we go. So we're going to buy this put option. How much does it cost to buy? It costs $9.32, right, per share. So one contract is 100 shares. That costs about $900 per contract, right? So let's see how I would use that. I would right click, buy a single put option. And I will analyze the trade. All right, so on the S&P ETF, you can see the two levels to watch would be the 282 level, which is my first target, and the 260 level, which is the second target, which corresponds to the ones on the S&P 500 index, right? So 282 and 260. So going back to our put option. So you can see that if the market were to drop to 282, if it were to drop to here about 280, 282, what would my profit be? All right, my profit would be anywhere from this line to that line. This is the expiration line. This is the date today. So I'll make roughly about $450 over here in profit per contract, right? And if the market were to drop to 260, which is the second target, you can see that I would make roughly about $2,000 per contract. Two grand. There we go. So by using this put option, you can see that the more the price goes down, right? Again, on the x-axis, we've got the price going up, price going down, right? So price going up, right? Price going up. So if the price goes down, you can see the more it goes down, what happens? That's right. Over here on the y-axis, you can see the profit and loss. So this is a zero line. Anything above is profit, anything below is loss. So as the market drops down to 260, you can see, right, you make $2,000 per contract. And of course, if it drops even further, if it drops all the way to 240, then you make $3,500 per contract. So the more the market drops down, the more money you make. So this is how you profit as the market collapses, and that hedges your stock positions. So a lot of people just use this put option. They use a straight put option. Now, I don't like to use straight put options. Why? The trouble is if you buy a put option, it's pretty expensive. Like in this case, it costs $900 per contract. It's pretty expensive, right? And the other thing about options is that they lose their value over time. So every day, it's losing time value. Okay, so your assets losing value over time. So time is working against you, and eventually it will expire worthless, right? If the market doesn't drop to where you want it to drop. So that's why I don't use put options by themselves. Another approach which I use at times is known as a put spread option. So what does it mean by a put spread? So I buy a put at the current level and sell another put at where I think the price is going to go. So for example, right now the market's at 288, for example. Right now it's about 288. And my first target is going to go down to 260. That's my first target. Correct? So what I do is I buy a put option with a strike price at 288. And at the same time, I sell another put option at the strike price of 260. So why do I do that? Because again, when you buy a put, it costs money to buy a put. But when you sell a put option, you receive premium, right? You collect the premium. So by selling a put at 260, I collect the premium to help me to pay for the put which I bought. So that lowers the cost of my trade, right? I pay less insurance. Now at the same time, when you buy an option, theta or time decay works against you. When you sell an option, time decay works in your favor. So in the end, it cancels out. So with that, I'm no longer affected by time decay. All right, and my profits are maximized at expiration. So we call this a put vertical spread or vertical put spread, right? So I buy a put at 288, I sell a put at 260. It costs me less to use this strategy, and I make a lot more money in the end. Right? So this is how I do that. Now the good thing about using a vertical put spread is, again, time decay doesn't work against you. So you don't have to get out of your option 30 days before expiration, when the most of the time decay happens. With a put spread, you want to hold it to expiration, because at expiration, you maximize your profits. So because of that, I don't have to buy 72 days to expiration. I can just buy 30 days to expiration, because I think that in 30 days or less, it's going to hit 260. So that makes it even cheaper to buy, right? So I'm going to go to my options that expire on the 8th of November in 30 days. And I'm going to again look at my puts over here. Again, this 8th of November. And I'm going to buy the 288 and sell the 260, which is somewhere here. Okay, I'm going to buy the 288 and I'm going to sell the 260, which is, well, somewhere up there, right? Okay, let me choose it like that. I'm going to right click, buy vertical spread. So this time, notice I'm using two legs, right? I'm buying one, I'm selling another one, right? So I'm going to buy the 288 and I'm going to sell the 260. Okay, so you can see that it immediately lowers the cost of my trade. Instead of spending $800 or rather $900 at a time, I only have to spend $500 per contract to protect my portfolio, right? And if I analyze the trade, what does it look like right now? It looks something like that. Okay. So that's my current price. We are now at 289. That's the current price. Again, on the y-axis, I've got profit and I've got loss, right? And on the x-axis, I've got the price of the S&P 500 ETF, that's going up, that's going down. So you can see that right now we are here, right? If it drops to 260, which is over there, that's my first target price, what happens? It drops over there, I will make a profit of, over there, I'll make a profit of roughly $2,300. But I have to wait to expiration to maximize the profits, right? So in this case, how much am I spending to protect myself? I'm spending $508, right? And when it goes down, I'll be making $2,300 in profit. So you're risking $1, or rather you're buying $1 in insurance to pay off $4 when the market goes down. So it gives you an even better risk to reward ratio, and again, don't have time working against you. So here's an example of how I use put spreads in the past to protect my portfolio. And during this time, the market was going through a bit of a correction. It was not a bear market, it was a bit of a correction. So you can see that the ETFs that I was holding, some of the stocks were having negative unrealized profit at the time. So for example, the SPY had an unrealized loss of 5,000 and another ETF was 700 and so on and so forth, right? So what I did at that time was I started to buy, as you can see, the SPY bear put options, right? So SPY bear put options, and I bought a straight put as well. So these are all the put options and put spread options that I use to hedge my portfolio. So as the portfolio went down, you can see that these put options over here, what did they do? That's right, they generated profits. And these profits were more than enough to cover the short-term losses of my stocks and ETFs. And the great thing is that the moment I closed my put options, I was able to pocket all these profits. And eventually, when the stock market recovered, all these positions became positive again. So I make money in both directions, basically. So these are some of the basic strategies that I teach together with my partner Bang Pham Van in our options online trading course. And to me, whether you're an investor or short-term trader, it is essential to learn these strategies to protect your portfolio and to profit in any market direction. Whether the market goes up or goes down, again, we can't predict the future, but wherever it goes, we gotta make money from it in any direction. Now, recently, I used the third strategy, and this was actually taught to me by, again, Bang Pham Van, who to me is a genius in options, right? So he developed a modified version of the calendar spread to use it to hedge my portfolio. And I thought it was brilliant because using a calendar put spread, I'm able to use even less money, right? Lower cost with even bigger rewards, right? So for every $1, I can hedge my portfolio up to even $10. And we call this a calendar put spread SnipeX strategy. And it's something that we teach in our advanced options trading course. So this is a sneak peek if you'd like to see how we use this strategy right now to protect our portfolios. Now, the great thing about this SnipeX calendar put spread is that it is so cheap that we can use it directly on the S&P 500 and not on the ETF, right? So going back to the S&P 500, SPX, so you can see that my next target, which I mentioned, if the market goes down, is about 2,821, right? So let's round it to 2,800 points, right? So I need to construct a calendar spread in such a way that if the market goes to 2,800, I get a huge payoff, right? And I want to pay very little cost to get this huge payoff. So we use a calendar put spread. And this is how it was constructed. Ready? Ta-da! There we go. Okay. So 2,800 is my target price, all right? So at 2,800, I'll do two things. The first thing is I'll go long the 2,800 put that expires on a certain day. So in this case, expiring on the 21st of October. Okay, and simultaneously, I would sell another put at the same strike price. So we call it a calendar spread. In a calendar spread, you buy a put and you sell a put at the same strike price, but at different expiration dates, where your long option expires further away and your short option expires nearer, right? So by doing this construction, what happens? This is what I get, right? So again, where are we right now? Right now we are at $2,893, right? So right now, let me just double check that. 2893, that's right. Okay. So right now we are here. Right now the market's here, right? And I am anticipating that it could go down to 2800. That's my first target. Remember that? Now, if it goes down, check it out. What's my profit? My profit, if it goes to 2800 at expiration, my profit will be, you can see the green box over here, the price is there. My profit will be 1763. That's right. So $1,763 in profit per contract. Now, here's the beauty of it. What's the cost of my contract? To buy this contract, it only cost me, you can see the cost over here. The cost was only about 200. In fact, less than that. It was about $180. Can you see that? So it's kind of like buying insurance. By paying a premium of $180, if the market goes down, if my house burns down, if my car gets into an accident, I get paid $1,700. And like I said, that is about 10 times, right? So for every $1 I pay, I'm being protected by $10. And this is the beauty of the SnipeX calendar put spread strategy that we are teaching in our advanced options trading course. And it's something that you got to learn if you want to really protect your portfolio with very little capital. So you can see over here that I have deployed some of these calendar put spreads in my portfolio. Well, let me see where it is. Yeah, over here you can see I started to deploy some of these calendar put spreads over here. Right? So these are what I just showed you just now. These are the calendar put spreads, right? With these are the target prices, right? 2855, 2830. So the moment the market, if the market goes down to those levels, then I would get a 10-to-1 payoff, and that's the maximum profit, right? Now, of course, the challenge with using calendar spreads versus straight puts or put spreads is that the price has got to go right to your target price. So you have to learn how to target the price correctly based on support levels, right? Sometimes if the price goes, it overshoots down too much, then you don't get protection anymore. So in those cases, you have to again create another spread at different strike prices. So no matter where the price falls, you get a payoff. So you have to learn how to manage the trade really well. At the same time, you only get the maximum profit at expiration. So as we move towards expiration, notice the purple line moves to the green line at expiration, right? So you have to wait for expiration or near expiration to maximize your profits in this particular strategy. So you can see there are many ways you can protect your portfolio, and there are pros and cons to each strategy, but you have to learn exactly when to deploy the right strategy. So these are things that we cover in our professional options online trading course. All right, so I do hope you enjoyed this video. So again, here are some of the lessons, right? Do not be freaked out by all the predictions that people make in the markets. No one can predict the future. All you got to do is to look at the current trend. So as long as it's on an uptrend, you can stay long in the markets. But the moment the trend goes down, you got to be flexible, right? You got to stop buying on a downtrend. And you got to learn how to protect your portfolio through all kinds of methods. And one method I showed you today is using put options, using put spreads, put calendar spreads. And again, if you want to learn more, take our online professional stock trading, investing, or options courses, where you can learn how to maximize your profits and minimize your risk in your wealth building journey. This is Adam Khoo, may the markets be with you. I'll see you in the next video. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.